Hello everyone, the main content of this video is about construction engineering economics, cost of capital for engineering projects, which will be mainly explained in the following two parts. First, the concept of cost of capital. Second, the cost of capital from various sources. First, let's introduce the first part. The concept of cost of capital. The cost of capital refers to the expense incurred by an enterprise when raising capital. Enterprises can raise capital through various means and channels. But regardless of the specific method, they all have to pay certain expenses and costs, which include the fundraising expenses and the usage fees. Fundraising expenses refer to various expenses incurred during the capital raising process, such as registration fees and agency fees paid for entrusting financial institutions to issue stocks and bonds on their behalf, as well as handling fees paid for borrowing from banks. Usage fees are the compensation paid by enterprises to capital providers for using the funds, such as paying interest and dividends to shareholders for funds raised through stock issuance, paying interest to creditors for funds borrowed through bond issuance and bank loans, and paying rent to leasers for using leased assets. Since the total amount of capital raised varies in different situations, in order to facilitate comparison, the cost of capital is usually expressed in relative terms. That is by using the cost of capital rate. The formula for the cost of capital rate is as follows. K equals D over left parenthesis P minus F right parenthesis multiplied by 100% equals D over P multiplied by left parenthesis 1 minus F right parenthesis multiplied by 100%. In the formula, K represents the cost of capital rate, often referred to simply as the cost of capital. P represents the total amount of capital raised. D represents the usage fees. F represents the fundraising expenses. F represents the fundraising expense ratio. That is, the ratio of fundraising expenses to the total amount of capital raised. Second, the role of cost of capital. The cost of capital is an important concept in enterprise financial management. Under market economy conditions, it is a major basis for selecting capital sources and formulating fundraising plans. A primary economic criterion for evaluating the feasibility of investment projects, and can also serve as a basis for evaluating the financial and operational performance of enterprises. 2. Cost of capital from various sources. First, cost of preferred stock capital. The cost rate of preferred stock capital can be calculated using the following formula. K sub P equals D sub P over P sub D multiplied by left parenthesis 1 minus F right parenthesis equals I over 1 minus F. In the formula, Kp represents the cost rate of preferred stock. Dp represents the annual dividend of preferred stock. Pd represents the par value of preferred stock. I represents the dividend rate. F represents the fundraising expense ratio. For example, a company issues preferred stock with a face value of 20 million yuan at normal market price, a fundraising expense ratio of 3%, and an annual dividend rate of 12%. The cost rate of its capital would be K sub P equals 2000 multiplied by 12% over 2000 multiplied by left parenthesis 1 minus 3% right parenthesis equals 12.37%. Since preferred stockholders bear greater investment risks than bondholders, the dividend rate of preferred stock is higher than the interest rate of bonds. Moreover, dividends are paid out of after-tax profits, which do not reduce the company's taxable income. Therefore, the cost rate of preferred stock is generally significantly higher than that of bonds. Second, cost of common stock capital. If the dividends of common stock remain fixed over the years, its cost rate can be calculated using the following formula. K sub C equals D over P sub C multiplied by left parenthesis 1 minus F right parenthesis equals P sub C multiplied by I over P sub C multiplied by left parenthesis 1 minus F right parenthesis equals I over 1 minus F. In the formula, Kc represents the cost rate of common stock. Pc represents the par value or market value of common stock. D represents the total annual fixed dividends. I represents the dividend rate. F represents the fundraising expense ratio. However, the dividends of common stock are often not fixed and tend to increase year by year, assuming an average annual dividend growth rate of G. The dividend for the first year is D sub 1. For the second year is D sub 1 multiplied by left parenthesis 1 plus G right parenthesis. For the third year is D sub 1 multiplied by left parenthesis 1 plus G right parenthesis raised to the power of 2, until the nth year is D sub 1 multiplied by left parenthesis 1 plus G right parenthesis raised to the power of n minus 1. Therefore, the formula for calculating the cost rate of common stock is K sub C equals D sub 1 over P sub C multiplied by left parenthesis 1 minus F right parenthesis and plus G. For example, a company issues common stock with a normal market value of 30 million yuan, a fundraising expense ratio of 3%, an annual dividend rate of 10%, and an annual growth rate of 5%. The cost rate would be K sub C equals 3,000 multiplied by 10% over 3,000 multiplied by left parenthesis 1 minus 3% right parenthesis and plus 5% equals 15.31%. Third, cost of bond capital. After a company issues bonds, the interest paid on the bonds is included in the company's expenses, which reduces its taxable income and thus its income tax payment. After offsetting these two factors, the actual interest paid by the company on the bonds is only the bond interest multiplied by left parenthesis 1 minus income tax rate right parenthesis. Therefore, the cost rate of bond capital can be calculated using the following formula. K sub B equals I multiplied by left parenthesis 1 minus T right parenthesis over B sub 0 multiplied by left parenthesis 1 minus F right parenthesis. In the formula, KB represents the cost rate of bond capital. B0 represents the total issuance amount of bonds. F represents the fundraising expense ratio. T represents the income tax rate. I represents the annual interest on bonds. For example, a company issues long-term bonds of 40 million yuan with a fundraising expense ratio of 3%, a bond interest rate of 13%, and an income tax rate of 25%. The cost rate would be K sub B equals 4,000 multiplied by 13% multiplied by left parenthesis 1 minus 25% right parenthesis over 4,000 multiplied by left parenthesis 1 minus 3% right parenthesis equals 10.05%. If the bonds are issued at a premium or discount, the cost rate calculation should take into account the difference between the issuance price and the face value. Let's look at another example. A company issues long-term bonds with a nominal value of 40 million yuan, an issuance price of 45 million yuan, a fundraising expense ratio of 3%, a bond interest rate of 13%, and an income tax rate of 25%. The cost rate would be K sub B equals 4,000 multiplied by 13% multiplied by left parenthesis 1 minus 25% right parenthesis over 4,500 multiplied by left parenthesis 1 minus 3% right parenthesis equals 8.93%. Fourth, cost of borrowing. When borrowing from a bank, the interest and fees paid by the company can generally be included in the company's expenses, reducing its profits, and thus its income tax payment. As a result, the actual expenditure of the enterprise will be reduced accordingly. For loans where interest is paid at the end of each year, and the principal is repaid in full at the end of the loan term, the borrowing cost rate is calculated as follows. K sub L equals I multiplied by left parenthesis 1 minus T right parenthesis over L multiplied by left parenthesis 1 minus F right parenthesis equals I multiplied by left parenthesis 1 minus T right parenthesis over 1 minus F. In the formula, KL represents the borrowing cost rate. L represents the total loan amount. I represents the annual interest on the loan. I represents the annual interest rate on the loan. F represents the loan fee ratio. Fifth, cost of leasing. When a company leases an asset and obtains its use rights, it must pay rent regularly, which is included in the company's costs, and reduces its payable income tax. Therefore, the leasing cost rate is calculated as follows. K sub R equals E over P multiplied by left parenthesis 1 minus T right parenthesis. In the formula, KR represents the leasing cost rate. P represents the value of the leased asset. E represents the annual rent amount. T represents the income tax rate. Sixth, cost of retained earnings. When a company retains a portion of its profits, it is equivalent to the shareholders of common stock making additional investments in the company, increasing the capital of common stock. Shareholders expect a corresponding rate of return on this additional investment, just as they do for the capital they have previously contributed to the company. Therefore, the company cannot use this portion of funds for free, and must also calculate its cost of capital. Since retained earnings do not require fundraising expenses, the calculation formula is as follows. K sub E equals D sub 1 over P sub 0 and plus G. In the formula, K represents the cost rate of retained earnings. D1 represents the first year dividend. P0 represents the total amount of retained earnings. G represents the average annual growth rate of dividends. 3. Weighted average cost of capital. The weighted average cost of capital, also known as the composite cost of capital, refers to the weighted average of the individual costs of capital for various fundraising methods, with the weight being the proportion of each fundraising method's amount to the total fundraising amount. In practice, due to various factors and considerations of risk and optimizing capital structure, project entities cannot rely solely on a single method to raise funds when financing. They must obtain funds from multiple channels, which gives rise to the issue of combining funds from various sources. Therefore, it is necessary to calculate the weighted average cost of capital for all sources of funds. The calculation formula is as follows. K is the sum, from I equals 1 to n, of the products of W sub I multiplied by K sub I, where K represents the composite cost of capital rate. Y represents the proportion of its source of funds to the total funds. K represents the cost of capital rate for its source of funds. Generally speaking, there are two ways to reduce the composite cost of capital. One is to reduce the cost of each source of funds, such as choosing loans with lower interest rates. The other is to adjust the company's capital structure and try to increase the proportion of funds with lower costs in the total funds. The above is the entire content of this video section. Thank you all.